Hello, everyone. Thank you all for joining us today for the Joint Whole Life First to Die Insurance National Webinar. Just so you all know, if you guys have a question during the webinar, please use the chat feature. Also, the presentation will be recorded and all of you will receive a link to the recording afterwards. So let's get down to business. Today, Seth Groff, the Life Distribution Development Manager at Assurity Life Insurance Company, will be educating you all on how joint whole life first to die insurance can solve a common problem with business partners. Seth brings over 9 years of insurance experience to the table. So without further ado, Seth.
All right, well, thanks Josh for that warm introduction, and I would like to welcome everyone to today's webinar titled The Business of Business Owners. And what we're going to do is we're going to take a look at how joint whole life first to die can solve a need for two business partners in a buy-sell agreement. And this is a market that excites me, and it has actually gained a lot of interest since we launched the First to Die product back in 2015. And there's really two reasons I like this market. Number one is there's a lot of opportunity, and we'll dive into that, and I'll prove that to you in today's webinar. And then number two, business owners tend to need a large amount of insurance, and they have the cash flow to fund these big policies. So as a result, they result in larger premiums, and as a result for you, they're going to result in bigger paychecks. So there's a lot of opportunity to make a lot of money, so let's not waste any time. Let's get started. Josh already gave you an introduction of me. You know, what I always tell people my job is to grow your business. And so I try to give you ideas that you can go out and use immediately to make a sale and ultimately grow your business. So if I don't do that today, please reach out to me and let's take a look at how else I can help you in your day-to-day business. You should already know who Assurity is, so I'm not going to spend time with it. If you need more information on who Assurity is, you can always reach out to your regional sales team and they can get you all the information to get you up to speed on what Assurity is all about. But let's take a look at what we will be covering today. First, we're going to look at the small business landscape, and we're going to look at the opportunities that are out there for you to go out and take advantage of. Second, we're going to look at prospecting strategies that I've picked up from having discussions with people that focus on the business market. Then I'm going to go into some questions that you can actually ask the business owners to set them up to lead down the path to help them fund a buy-sell agreement. And then finally, we're going to take a look at, again, we're going to look at our first to die joint whole life policy and how it can solve two business partners' problems that they face in a buy-sell agreement. And if there's time at the end, we'll definitely answer any questions that you have. If you have questions that come up during the presentation, as Josh mentioned, use the chat feature. So as you can see, if you take a look at this slide, according to LIMRA, 62% of businesses are considered small businesses. But that's not really what I want you to focus on this slide. What I want you to focus on is that 1 in 4 small business owners do not own life insurance. And I think that statistic is actually pretty shocking. And it always leads me to the question of why is that the case? Why does only 1 in 4 small business owners, or why does 1 in 4 small business owners do not own life insurance? It's either one, they don't want it, or they don't think they need it. Maybe they think they can't afford it, or no one has asked. And so you need to get out there and talk to these people because there is a tremendous opportunity if you're willing to go out and work. Now that leads us into the next slide, and I think that this is pretty shocking as well because you can see that 65% of small business owners have actually thought about who would run their business in their absence, but only 64% do not have a business continuation plan. So what that tells me is that we are not doing a good job as insurance professionals at getting out there, talking up to these business owners, educating them about the risks that they face, and then educating them on the solutions that we can provide. So anybody that says there's not an opportunity in this market, in my opinion, is wrong because these business owners are thinking about the products that we provide. They're thinking about the solutions, and we're just not doing a good job of getting out there and showing them how we can deliver on the solutions. Also, I just like to throw this slide up there that 52% of the small business owners actually like to use independent, multi-company brokers like you. So if you're on this webinar, I'm guessing you probably represent several different companies. Business owners are actually more likely, you can see 52% more likely to use an independent broker over like a career agent. And so I think that sends a strong message about what we can do in the independent space. So bottom line, the opportunity is there. You just need to make a decision today if you are going to go out and take advantage of this opportunity, or if you're just going to sit back and let someone else work this marketplace. So let's take a look at some different prospecting strategies. You know, I wish I had a silver bullet for you for prospecting, but the reality is that it doesn't exist. Bottom line, prospecting takes work. You know, I have reached out to some of the agents that focus on the business market and asked them how they get clients. And, you know, all three of them actually indicated that it takes work and it takes time. So you have to be willing to get out there and prospect in order to gain these clients. But the three that came up the most often, one is obviously be where the business owners are. So whether you participate in Chamber of Commerce, Rotary Club, lead group, executive councils, you need to be where the business owners are and network. When you're doing this, remember, always give value first. Whenever I meet somebody, a new business owner, I always ask myself, who do I know that can use their service? Because the greatest thing you can give another business owner is a referral. And once you do that, you're in. They're going to be more likely to sit down with you and talk about how you can provide additional value to them. Also, another great way to work this market is to network with other advisors. You can become the business market expert. Obviously, trust is critical, but if you just establish yourself as the expert in this particular market, it's more likely that other agents would be willing to split business with you and bring you in on some of their cases. I have seen this type of relationship work really well with P&C agents that write commercial business, and they already have an in with the business owner. That business owner, you know, asks them about life insurance. It's kind of out of their wheelhouse, and so they're looking for someone that they can bring in as an expert. Obviously, you got to establish trust with those agents, but there's definitely an opportunity out there if you can network. I've also seen it work well with health agents that write group health insurance. Again, they're already in these businesses, so they have an in, and you might be able to come in and help them sell in this business market. Finally, the third prospecting idea is going to be to target a niche. You know, pick an industry that you're familiar with or that you already have an in with. Maybe one of your good friends is in that industry. But really focus on that particular industry and really understand what that industry's specific needs are. Because people that work in the same industry, they network just like insurance agents network through organizations like NAIFA. Other industries network as well. And so if you get in there as the expert, they're more likely to refer you to their colleagues. So pick an industry, become an expert, truly understand their language, and truly understand their specific needs, and then you're more likely to get referrals in that particular industry. So again, I wish I had a silver bullet. All these take work, but this will at least give you a place to start. You know, one that I didn't mention and don't have up there, but just think of the small business owners that you work with on a daily basis, right? So maybe you take your suits to a dry cleaner. That's a small business owner. Maybe you take your vehicle to a mechanic. That's a small business owner. We interact with small business owners every day, yet we're afraid to ask them if they've done any, you know, continuation planning. So there's the other place that you can prospect, is the people that you talk to on a regular basis just in your day-to-day life. So events to consider. You know, again, what we're going to look at today is how joint whole life, first to die, can be utilized to fund a buy-sell agreement for two partners. As insurance agents, we typically only focus on the death aspect of a continuation plan, but the other topics that you need to be bringing up, one is retirement. Okay, so is one business partner a lot older than the other business partner, and is there a likelihood that one is going to retire earlier than the other business partner? Because if that's the case, at some point in time, there's going to be a buyout, and where are they going to get that cash for that buyout? Also, divorce is always going to be a topic that you need to consider. Obviously people don't like talking about that as a possibility, but a reality is that a lot of divorces do take place, and when they do, it can cause havoc for small business owners. Disability, again, another topic that often is overlooked in continuation planning, but the reality of a business owner becoming disabled during their working years are actually higher than dying prematurely. So definitely something else we need to look at. And then obviously what we're here to talk about is how to prevent or how to fund that buy-sell agreement in the event of a premature death. So obviously when there is a death of a partner, there are some questions that we need to ask that business owner. Obviously you need to ask them, how will the business continue? Or will it even continue, right? Maybe once one of the partners dies, then, maybe the other one's going to quit, but that's usually not the case. Usually it's going to continue, so you need to ask the question, how will it continue? Who will control the business? Obviously, the obvious answer is probably the surviving partner, but what if the deceased partner has a son that wants part of the business? Or what if they have a spouse that wants part of the business? And then does the surviving partner want that family member to get involved? These are all questions that you need to ask the business owner and get them thinking about that will help you, ultimately close the deal. And then finally, the $1,000,000 question, that's why we can provide good solutions in these buy-sell agreements, is how will the continuing owners finance the buyout when the partner dies? And that's what we're really here to talk about. So if you're not familiar with a buy-sell agreement, it's pretty straightforward. One owner dies and the surviving owner purchases the owner's share of the business. Again, the $1,000,000 question is, where does the money come from? Obviously, they can get it from working capital from the actual business. The problem with this is, are they going to have to liquidate part of the business? Or do they have the opportunity to liquidate part of the business? Often they don't want to do that, because if they have to liquidate half the business, it's going to impact how the business's success moving forward. So that's typically not a great option for the business. Maybe the surviving partner can go to a bank and borrow funds to take that loan. But that always is contingent on, will the bank loan them money? Maybe the bank is less likely to loan them money if a key owner has passed away, because now the success of this business might not be as clear, and so banks might not be as likely to loan the surviving partner the money to do it. So life insurance might be a good option. So let's take a look at why life insurance might be a good solution. Obviously, it's because it's going to create funds immediately to execute the buy-sell agreement. And so it's going to create the cash so that the buy-sell agreement can take place. It's going to create a market for the business. And I mean that there's a market. They get to predetermine what the price of the business is going to be at the point when they want to sell it. So it's not, a situation where now they have to, value the business at that particular time. They get a preset what the price of the business is going to be, and then they know there's going to be enough money there to actually purchase it for that price. Also, it's going to allow the surviving business owner to maintain control, so they don't have to worry about, a family member of the deceased coming into the business. There's going to be money there to help pay any taxes. Obviously, if you use cash value life insurance, which we're going to talk about today with the joint whole life first to die, now that cash value life insurance builds cash value, maybe now we can access that cash value at something other than death, like a retirement, to fund the buy-sell agreement. Obviously, when you have life insurance, it creates better credit risk. The bank is more likely to loan you money because they know that life insurance is there in place, and that can be used to pay off the loan if one of the deceased partners dies. And then ultimately, why does someone start a business? And the ultimate reason is to provide for their family. And all the life insurance and the buy-sell agreement is going to do is make sure that deceased family members or that deceased partner's family is taken care of, and that they get what is rightfully theirs. So, ultimately, it's what you want to happen will happen, and these are really the advantages of using life insurance. So let's take a look at questions that you can ask the business partner when you're having these questions or when you're having these conversations. Now, I'm going to be upfront with these questions, and that all these questions are leading down to a joint whole life first to die policy. So all these lead down to a cash value type of insurance plan, specifically whole life and joint whole life. So just keep that in mind, because when I'm going through these questions, I'm going to kind of break off and explain how they relate to the solution that we're ultimately going to show to the client. So the first one is, do you think the value of your business will increase in the future? Most business owners are going to say yes. So my follow-up question is going to be, would it be beneficial to have a policy where the death benefit increases as well? And they're going to say yeah. And why we can say that is because, remember, the joint whole life first to die is a participating whole life plan. And what that means is that it will receive dividends. And if we put those dividends back into the policy as paid up additions, that death benefit's going to increase as time moves on. And so it probably won't increase, in the same proportion as the business, but it will increase, and you can show that as an advantage to going with this solution. The next question that I ask is, do you want flexibility in your premium payments? Obviously, this is beneficial if you have fluctuation in your cash flow, or if you want to be able to stop premiums at some point in the future. Now, a lot of people, when I say, do you want flexibility in your premiums, they immediately jump and start thinking about a universal life plan. But whole life insurance is actually pretty flexible. We can structure this policy, to be paid up at 65 or at some other point in time. It does take a little bit of manipulation on the software, but it's flexible, and you get to decide how long you want to fund this thing. We can set it up that way. Also, once there's cash in the policy, if that business has a down year, and if there's enough cash in the policy to cover the premiums, we can just have the premiums paid from the policy value. So there is some flexibility with whole life insurance. It's often, people don't think it's flexible, but as soon as you get some cash in there, there's a lot of different things that you can do with the plan. You can ask this question to the business owner. Also, a question that I like to ask is, do you want your policy to create an asset or liability on your balance sheet? Remember that we're talking about a cash value plan. So if you sell term insurance, and let's say you sell a 10-year term insurance to this business owner or these business partners, 10 years down the road, hopefully they're both still alive. Odds are they are still alive. They had the insurance which they needed, but ultimately that's a liability on their balance sheet, right? You just had the cost of insurance. But with these whole life policies, and specifically joint whole life first to die, they're going to build cash value. So 10 years down the road, there's going to be cash value in this plan. Depending on how you structure it, may or may not be more than the premiums paid, but 20, 30 years down the road, now you're going to have actually more cash value than premiums paid, and now you really are creating asset on your balance sheet instead of a liability. And you really have to put an emphasis on this because, business owners, they're going to typically lean towards the lowest cost, which, typically results in a term policy being sold. But if they have the cash flow and you can show them how they're just reallocating assets with a permanent policy, it's actually more beneficial to the business owner, and it's going to result in a bigger sale for you. So that's a great question to ask when you're talking to a business owner. Also, a question I like to ask is, do you want your policy to only provide funds for the buyout in the event of death, or do you want it to provide funds in the event of one owner retiring? Again, that's leading back to the cash value portion of the life insurance plan, and so that's a great leading question. Another question that I like is, do you want your premiums to be guaranteed for the entire life of your policy? This is very powerful because if you think of business owners and the other insurance that they have to buy, what typically happens from year to year is that it actually increases. So for example, let's say they're paying for major med for their employees, right? Or some group health insurance. That premium's probably going to increase every year. They don't like that, right? Same might be true for their PNC or their PNC insurance or commercial insurance. That might increase every year. So what you can say with this whole life policy is, hey, let's get this locked in today. The premiums are guaranteed for your entire life and will never go up. So we can get them locked in, and they're going to remain the same for the rest of your life. They like that aspect of whole life, that they know that it will never increase, and so that's another powerful question. And then finally, do you want your policy to build equity that could be utilized as collateral for a business loan in the future? Or if they don't want it to use it as collateral, they can actually borrow against their policy as well. So there's a lot of advantages, and I like asking those questions because it really leads them down the path to the question, what policy gives the business owner what they want? The answer is whole life insurance, and specifically joint whole life, first to die, when there are two business owners. So you might be saying, well, so Seth, what is joint whole life, first to die? This is a product that Assurity launched in 2015. And the way that it works is that we insure two lives on one policy, and we pay the death benefit in the event of the first insured's death. Okay, so we insure two people on one policy, pay the death benefit in the event of the first person's death. Okay, you say, well, why would anybody want to do that? Well, the short answer is it's a more affordable way to get insurance on two people than buying two individual Assurity whole life policies. So that's really the advantage. When we launched this product back in 2015, the primary market where we were focusing this product was selling it to couples or, married individuals that rely on both incomes to maintain their lifestyle. So we were really focusing on that dual income household. And, we've had a lot of success in that market as well. But this buy-sell market has actually picked up a lot of traction. It's generated a lot of interest. It's resulted in some big cases. And so that's really what we're here to talk about today. So when we look at joint whole life and what the issue ages are, the issue ages are 0 to 85, but that's not what I want to focus on. The point of this slide is to educate you that based on their individual ages, the software is going to calculate a joint issue age, okay? And the reason you need to know that is because when you're looking at the illustration, there's going to be a joint issue age, and that's what the values are going to be based on, is that joint issue age, not their individual ages. You don't need to know how to calculate that joint age. All you need to know is their individual ages, and then the software does it for you. But just be aware that there will be a joint issue age based on their individual ages, and you'll need to be able to walk them through that on the illustration, because it starts at their joint age, not their actual age. Another question that always comes up is, how is it underwritten? This product is a fully underwritten product, okay? So it's underwritten like a traditional life insurance product. But what I want to point out on this is that both insureds need to be insurable, okay? Because when a lot of agents hear the term joint whole life, what they think about is they think about joint whole life second to die, okay? And sometimes on second to die policies, you can get an insured on the policy that, might have some significant health risk. But remember, this is a first to die policy. Assurity is on the hook for the first person's death, so we need both of them to be relatively healthy or insurable to get this plan in place. The other thing that I want to point out is that they're going to be given a joint underwriting class. So we underwrite each individually, we give them their own risk class, and then based on their individual risk class, then they'll get a joint class. So, for example, if they both come back preferred, there'll be a preferred risk. If one's preferred, one's standard, they'd come back standard. If they're both standard, obviously they'd be standard. There's also a combination risk class. So if one's tobacco and one's non-tobacco, there's a combination, and then there's a tobacco risk class as well. We also can do table ratings on this policy as well. So we can take on some risk, but just remember that both of them do need to be insurable. Another question that comes up is going to be, what if the business breaks up? Okay, and that's a fair question because a lot of these small businesses will break up. We wanted to keep it pretty simple regarding this, and basically what happens is we surrender the cash value and we return it to the policy owner. Typically when you're setting these up in buy-sell agreements, there's going to be one of two setups. One, the business is going to own the policy, and if that's the case, then obviously the business would get the cash value. If the two business partners are joint owners on it, we'd split it 50-50. So either the business is going to own it or the partners are going to be joint owners. Either way, we return the cash to them, and then each insured can purchase their own policy up to 50% of the face amount without proving insurability. So even if the business breaks up, they're not going to be, left hanging. They can go out, get their own policy up to 50% of the face amount without proving insurability. So we definitely took that into consideration. Another question that always comes up with this policy, since it's different than what you might be used to, is what if the surviving business owner still has a need for life insurance? And that's a fair question, right? Because this is a first to die policy, so this pays the death benefit in the event of the first insured's death. So what about that surviving insured? And we took that into consideration as well. As long as the surviving insured is 75 or younger, they have 90 days to get their own policy in place without proving insurability for the original face amount. So you can decide, or that partner can decide at that point in time, assuming they're 75 or younger, they can decide if there's still a need for life insurance, and if there is, they can get a policy in force without proving insurability. So this is huge, because if you think about one of the problems with the buy-sell agreement is you don't know what partner is going to die first, right? So typically what happens is you have to write policies on both insureds. Well, when the first insured or the first partner dies, then there's still this other policy out there, and the question is, well, now what do we do with it? And obviously, having too much insurance is never a huge deal, but here they only have to pay for one policy, and then in the event of that first person's death, guess what? Now we can decide if the surviving partner still has a need for it, and if they do, as long as they're under the age of 75 or less, they have 90 days to get their own policy in force without proving insurability, which is a huge benefit. Another feature that I like to talk about this policy is what if the business owners die at the same time or on a business trip, and if they die within 24 hours of each other, we actually pay the benefit on both insureds. So if they have a $100,000 death benefit and they die within 24 hours, we'd actually pay out that benefit twice on both insureds as long as they die within 24 hours. Obviously, if they live longer than 24 hours, you can always implement the survivor benefit and get that in force as well. So there's a couple of different options there. So circle back, why joint whole life? Remember, anytime you talk about whole life insurance, whether it's joint whole life, first to die, or just a continuous pay LifeScape whole life policy, remember the advantages are the premiums are level and guaranteed, right? So they can lock this coverage in force and they don't have to worry about it increasing in the future. Also, since it's a participating plan, we're going to receive those dividends. They can be put back into the policy to enhance the cash value and the death benefit growth. Remember that we have the ability to stop premiums at some point in the future as long as we structure these policies properly. So if they only want to fund this till age 65, we can show them how to set up a policy to do that. One of the things I didn't talk about in the webinar is the waiver of premium on this joint whole life first to die policy. A lot of times I like to add this on this because then I can say if either partner becomes disabled, we'll actually waive the entire premium with that waiver of premium and ultimately creates a self-completing policy in the event of a disability. Also, remember that the advantage of this is that it's going to be 25 to 35% savings over two individual LifeScape whole life policies. So if you look at our standalone continuous pay whole life policies and you quote it on both insureds, the joint whole life is going to be 25 to 35% less expensive than purchasing two of those LifeScape policies. You might say, well, 25 to 35% doesn't seem like much, but these policies are typically a lot larger than just writing an individual policy. So they're big premiums. And when you start looking at 25 to 35% savings, it's pretty significant. And we'll go through a case study so you can see how much savings it is. And it adds up, especially if you add that 35% or 25 to 35% savings for 20 years or 30 years or however long the policy is in force, it really adds up. So there's some huge advantages to this plan. And then obviously, remember, you don't have to pay for two policies. And if you still need that continued insurability, you can determine if you need insurance at that point in time. So that's why joint whole life. So let's take a look at a case study. We have two partners. They have a successful interior design business. Crystal, age 41, Lindsay, age 46. And they decide that if one of them would pass away prematurely, they would need $300,000 to purchase the remaining half of the business. And so, the agent went through and asked those questions, those lead-in questions, and they really liked the idea of whole life insurance. They liked the benefits of having that cash value. But when they looked at the cost of two policies, they just said, hey, man, this is too expensive. What else do you got? So the agent actually presented joint whole life first to die. And you can see that if they wrote two individual LifeScape whole life policies, the total premium was $885 a month. By writing the joint whole life, it actually lowered the cost to $594 a month. So that's $290 of monthly savings, which adds up. You can see that's almost $3,500 a year in savings, and that actually comes out to about a 33% savings. So you save the client the client's 33%, or almost $3,500 a year. And I don't know about you, but for a small business owner, that's pretty significant savings. And that's going to get them excited, and that's going to really show them what your value, the value that you bring. And so the fun question is, okay, so I saved them that much money, and now the question is, what can a business owner do with these savings, right? So this is the fun conversation, because you saved them almost $300. Maybe you want to put that money back into the policy in the form of paid-up additions. That's going to enhance the cash value and death benefits. So if they want, this to build a little bit more cash, that's a great option. Maybe you want to add another layer of protection to their buy-sell agreement. Maybe that includes a larger death benefit. Maybe it includes some sort of disability policy on the business owner. Maybe it includes a critical illness policy. Whatever the case might be, just maybe get them more protection. And then finally, maybe they just want to invest it back into the business. And if they want to do that, that's great as well. It'd be nice maybe to get all that savings, but maybe they just want to put it back in the business, and they have that option as well. So the bottom line is that this is an idea that is different from what business partners have seen. And so you can get out there, you can show them an alternative solution to the buy-sell agreement. You can really provide them some additional value, and as a result, you can really grow your business. So the last thing that I want to talk about is, what does an ideal business look like? Because I'll be candid with you, not all businesses are going to be a fit for permanent insurance in their buy-sell agreement. So what I always tell people is that the business has to be established. So I always say, look for businesses that have been in business 3 years or more. Typically then they're going to be established a little bit more. They're going to have a little bit better cash flow, and they're going to be more likely to be able to afford and be willing to pay for a permanent solution to their buy-sell agreement. If you're talking to a startup and they can barely make payroll, they're just not going to be a good fit. Maybe you write them some term and you move on. Maybe you talk to them about joint whole life once they're a little bit established. But you need to make sure that the business is established and has the cash flow to be able to afford a permanent solution. Also, I always tell people they have to have a strategic vision, right? If this business only thinks they're going to be in business for 5 years or 8 years, then write them term insurance, because they don't have a need for life insurance for a buy-sell agreement past that point in time. But if they say, hey, I'd like to see this business go on for a long time, I'd like to see it go on to my younger partner or one of my kids, whatever the case might be, if it's sometime going to transfer, you need to make sure you have a permanent solution. And then they just really need to understand the importance of that long-term strategy. So some business, like I said, term's going to be the best solution, but in others, first to die, joint whole life is going to be the best solution. So with that, I'd like to thank you for jumping on today's webinar. If you'd like some more additional information on the stuff that we covered today, the contact information for our sales team is up on the screen. As Josh mentioned, when we kick this off, we will be sending out a recording of this webinar to all the attendees. We will also be sending out the case study that we discussed, and we will send out the PowerPoint presentation, so you will receive all of that. If you have any questions, go ahead and type them into the chat feature. I have Marisol actually feeding me some of the questions, and one of the questions that came up is that, so in a partnership, owner is company, insured or partners, first death is the buyout, correct? Yes, that is correct. So if the company is the owner, obviously, then in the event of that death, the death benefit goes to the business, and they ultimately buy out the deceased partner's family. So that's the way that it sets up. In 90 days, two-person takes out new policy, no underwriting, but at current age. Yes, in either situation, if they do the, they have to terminate the policy because of business dissolution, or if the first person dies and the second one still needs insurance, it is going to be at the current age. It's not at the original issue age. So, yep, those are both good questions, and they do come up a lot. Marisol, are there any other questions?
Yep. Does there need to be insurable interest between the two joint insured?
Yes. Yep. In any situation, the question always comes up, different scenarios if they can use joint whole life, and whether it's a business. Obviously, in a business situation, there's going to be insurable interest, but for any other situation, both insureds do need to have insurable interest. As long as they have that insurable interest, you can use the joint whole life. I will throw out there, though, when you're splitting the policy, the way the contract language reads is that you can split the policy due to divorce or business dissolution. So, when you get into those weird situations where, maybe you have a couple that has lived together but not ever officially got married, per the contract language, could they split the policy? Maybe, but the contract specifically says divorce and business dissolution. So it does get weird there when you're talking about insurable interest and they're not business partners or they're not married. Obviously, they could surrender the policy. They just might not be able to get the insurance without proven insurability. So what else do you have, Marisol?
How far apart in age can the owners be?
They can be as far apart in age as you want. When you get too spread out, your savings dwindles a little bit. But ultimately, the issue ages are 85 to 0, and there's no limit on how far they can be. What I always recommend is just run the illustration and then compare it to two individual policies and still make sure that the savings make sense, which it'll always be less expensive than two individual Assurity policies. It just depends on how much. All right, looks like we have one more question.
Okay. In 90 days, the second partner chooses to add a policy on themselves. No underwriting, but what cost? Is it at current age or age when the policy was taken?
Yep. So I answered that, but I'll hit it again. It's going to be at the current age. So as long as they're under 75, they don't have to prove insurability. They can get their own policy without up to the original face amount, but it is going to be at the current age. So you have to keep that in mind. But here's the way you got to look at it. Think of all that money you saved them by going with this joint whole life policy. So, in the long run, it's actually going to still end up saving them money, but they do need to be aware that it is going to be at the current age. Yep. All right, looks like there's one more question.
In a buy-sell agreement, can the premium be income tax deduction?
No. In buy-sell agreements, the way you're going to set it up, you're going to pay for it with after-tax dollars. So the business is not going to be able to deduct the premiums. Yep. But, then you receive the benefit tax-free, and so it always goes back, do you want to pay taxes on the seed or on the harvest? And obviously, I know business owners want to try to deduct everything possible, but no, in this scenario, you want to pay for it with the after-tax dollars. So, all right, well, that looks like all the questions. Hopefully you found this beneficial. Again, I just want to reinforce, get out there and have the conversations. If you don't use, the ideas we talked about today, then it was a waste of your time and it was a waste of my time. So get out there, make a sell. If you have questions, you're still not sure, reach out to our sales team. That's what we're here for. We can get you up to speed. We can give you the tools to be successful. And I am confident that you can go out there and grow your business. So I would like to thank you again. That's what I have for today's presentation. Be sure to look out for next month's national webinar, and hopefully you found it beneficial. So thanks again.